All right, hey guys, Jeff Kamke here with Wealth Energetics. I'm here. It's been a while, but we got Matt Toishel with from Millennial Wealth Creator, and we're gonna do some content. It's 2025, and we haven't. I don't think it's been since last year. Gosh darn it, Matt! So
It's been a
excited
while,
to
man. I
jump
was
into
starting
some.
to starting to worry about you.
Right, right. I know. I miss you, brother.
Got to get back on the bandwagon here.
Exactly. So today we're gonna go over some Dave Ramsey stuff because if you've watched Matt and I before, we love to take our little pokes at Dave. I mean, we agree with him on some stuff, but there's some other things that we are in a different perspective on. So today we're gonna go over some of those things around a post that was made on social media a while back, and I'll actually switch my background here to show what post that was here real quick because it was talking about home ownership and how it can be just this phenomenal, asset in your life, and it can create all this wealth. And think over my
Outrageous
shoulder,
wealth.
outrageous. Yeah, you
Yeah.
brought out the O word,
Hmm.
outrageous wealth. And the post that I had responded to about that was some of the things we're going to get into in this video, where there's just a different perspective. So much that Matt and I talk about on our individual channels, and that we teach clients, work with clients on, is just a different perspective around wealth, around money, and so many times we're locked into a certain viewpoint because that's what everybody talks about. It's what we hear from the Dave Ramseys. It's what we see in all the books on the shelves in the bookstore around personal finance. And there aren't that many people out there talking about a different perspective around money. It's not that one is right or one is wrong, but having different viewpoints. I love you always talk about this, Matt, with a lot of the conversations around IUL is just expanding your awareness, having a different viewpoint, seeing somebody else's perspective and how they see something, see a belief system, see a framework that maybe if you learn something different, there's a better fit for what you want to do versus what you've been told before. Maybe you're just caught in somebody else's belief system that isn't in alignment with what you want or what is going to get you where you want to go. So some of the things we're going to jump into today are just breaking down this post that I've got behind me here and a couple other things that we've heard from Dave talking around the whole house paradigm. There's some principles that he teaches that, we're going to share some perspective on it, pros and cons, and get you to think a little bit differently about, some of the different aspects as it comes to home ownership. And does it really build wealth? Does it really help you in retirement? Does it really help you with the next generation? And just shed some light on some of these different aspects around Dave's philosophy and, some pros and cons. So ready to jump into some of this, Matt? I'll share a couple thoughts and then I'll turn it over to you and get yours.
Sounds good.
I think when I first heard this post and saw this on Facebook, I think this is actually off of Instagram, but this post talking so much about that if you have a home, you buy this home and you follow Dave Ramsey's principles and you really live tight and scrimp and save and you put a lot of your extra resources after you've paid off your debt into paying off your home, gosh darn it, you're just going to become wealthy. And then, like this post said, just outrageous wealth can be created from your home. And now this post does go on to talk about and promoting the book, which I'll get out of the way, the real estate, method that Dave teaches, which is beyond owning your own home. It's really getting into investing in real estate and being able to, maybe do fix and flips, or I don't know all of what Dave teaches and whatever, but I know a lot of them come around the principles of doing it with no debt, doing it, safe and secure, and in a way that, for some people, it may not make sense to be able to do. So we're probably not going to touch as much on the real estate investing portion of this post and hunker down more on just the home ownership part. So the first thing I know when I saw this that jumped out at me was, well, if I have a home and I've paid it off, how is that going to create outrageous wealth for me? I mean, I really struggled with wrapping my mind around where's this creating wealth for me? I have an asset, absolutely. It's more than likely appreciating in value, especially if you've, had it paid off in the last several years. You might have doubled your money in the last few years in your value of your home. But as you get older in life and you approach the retirement stage, and at that point, what good is having a paid off home going to do for your wealth? Because in retirement, you're looking at it from what am I doing to produce cash flow? Your home isn't going to produce cash flow. It does look really good on a balance sheet. It looks really good on net worth numbers, right? If you got you maybe bought a $250,000 home in, the year 2000 and now it's worth, three-quarters of a million or $1 million or something like that, and like, yeah, it looks really good on paper. If you've got no debt, you got this house that's worth just a lot of money. But then how does that actually translate into your life? What is it doing for your life as far as cash flow goes? Because in retirement, it's not really so much about how much you have parked away. It's about how much cash flow do you have coming in a predictable manner that meets your needs, that gives you some freedom and flexibility, because your retirement years are supposed to be the golden years, the best years of your life, to be able to do all the things that you put off doing, to travel, to spend the time with the people that you love. Well, having the home paid off certainly has its benefits, and we'll get into those, but looking at it strictly from creating wealth and what it's going to do for you financially, it doesn't really produce anything. There's no production from it. The only way to access that money in the value of your home would be to sell the home, which you could do, and liquidate it, but then you no longer have a home that's paid off unless you're downsizing, which many people in retirement can do that. And then the other way to access it would be like a HELOC, right? You go to the bank and you get a loan, but that by itself is in contrast to Dave's principles. He doesn't teach you to go into debt. So if you're really going to want to access the value and the wealth that's been built up in a paid off home, you have to go get a loan in order to access it. So those things don't make a whole lot of sense when you're actually looking at it. And the big question for me, Matt, is, does this home really add to my wealth? It certainly can, as far as net worth. It certainly can as terms as a legacy play, which we'll get into some of those pros and cons as far as the legacy play goes. But I think those are my initial reactions. I'm interested to hear what your thoughts were around this Dave Ramsey post around home ownership.
Yeah, for sure. It's all really good stuff. I was actually taking some notes on some of the things that that you were talking about. So the first thing I want to say is, even though we disagree quite a bit with Dave Ramsey, there's some things that we agree on, whatever. I think, we do need to give credit to Dave a little bit where, even though we disagree, a lot of the things that he talks about and teaches, he makes it really simple for people to get started on the right path, because a lot of what he teaches is absolutely better than doing nothing, right? Where the next stage though after you get started is how do we accelerate the wealth building process? How do we become more efficient? How do we make better, more strategic financial investments and decisions and things like that? And that's where we don't really agree with Dave, but I do want to give him a little bit of credit, because he makes it really easy for people to get started. And with regards to home ownership, I'm a big fan of owning a home. I think it can be a very good decision in the right context, in the right situation, when you're actually ready for it. I'm actually renting right now, but that's just because that's the phase of life that I'm in. It makes more sense for me to rent at the moment, but I absolutely plan on buying a home at some point, because there's a lot of benefits to doing it. Is building wealth one of those benefits? Well, that's a rabbit hole that we're going to kind of go down in this video. But for me, as far as building wealth, like I also thought about when you were talking about some of your points there, I thought about Robert Kiyosaki, right? Another big time, mainstream financial guru, whatnot. I've learned a lot from Robert Kiyosaki. There's some of the things that he says that I don't agree with, but that's fine. And he actually says your home is a liability. So this is where the thought process really needs to start coming in. Doing your own critical thinking, doing your own research, analyzing your current situation, and then making informed decisions. Do I buy a home now? Do I not? Do I do a 15-year? Do I do a 30-year? Right? As opposed to just taking what everybody says at face value, doing your own research and applying what you learn to your current situation, right? And here's the thing. I actually agree with both Dave and Robert Kiyosaki to a certain extent on some points. So let's break that down. We'll start with Robert Kiyosaki's take on owning a home. If you think about it, your home actually is a liability. If you're thinking about your life from a business standpoint, assets put money into your pocket, liabilities take money out of your pocket. And I don't think anybody can argue that it's pretty expensive to own a home, right? Think about how much money you have to put down. You have to, like, all the maintenance that's involved with it. You got property taxes, insurance. So you have all this money pouring out of your personal economy every single month. Okay. So from an income perspective, that's a liability. It's not an asset. Okay. With that said, there's another side of the story. Does your home appreciate over time? Appreciate in value over time? Generally speaking, yes. The question is, as you alluded to earlier, Jeff, what is that doing for your cash flow right now? Because at the end of the day, it's all about cash flow. Like, especially when we're talking about retirement, which is kind of one of the things that Dave Ramsey alludes to when he says your home building outrageous wealth. Well, it takes time for that wealth to materialize on a balance sheet. Again, it's still not generally producing any cash flow. So the question is, are you actually getting any real benefit from a financial standpoint, from a cash flow perspective? Or is it just taking money out of your pocket every single month, right? And it comes down to what your goals are and how you're utilizing these different assets. A house can absolutely be an asset in the long run, depending on how it, in my opinion, how it fits into the financial plan, how you're going to use it. Maybe you don't buy a home for building wealth. It's certainly not part of my wealth building strategy. Like when I go to buy a home, I'm not making that move to build wealth. Okay. When I build wealth, it's in my business, when I'm doing my private money deals, when I go to networking events and then we form strategic partnerships, or you actually invest in real estate, like rental properties or something like that. Right. To me, that's more on the wealth building part of the spectrum versus we're just going to buy this asset. It's going to increase in value, but it's not really doing anything for us. Now, it can absolutely be a legacy play, I suppose, even though I think there's better ways to build a legacy than just the home. All right. But if it's something you want to pass on to your kids and grandkids, as you mentioned in the post, that's great. But what is it actually doing for your wealth other than just showing up on a balance sheet, showing up in your net worth? Because net worth it's not producing cash flow unless you start to utilize the asset in that way. Whether, maybe you do a home equity line of credit, maybe you do a reverse mortgage. I'm not too familiar with reverse mortgages, but I know people use them in retirement. So it just comes down to how that asset is actually producing true financial value. We're not talking about the experiences and this is where I'm going to raise my kids. We're not talking about that. We're talking about the wealth aspect of it. And at the end of the day, a home is just, it's the value of the home is just a number on a piece of paper. That's it. Right. Not to mention you need permission as well to access that. That's a whole other conversation. I'm trying to work with my brother right now to get a HELOC on his home. He has lots of equity. He wants to use it to consolidate debt. We ran all the numbers. It makes absolute sense. It's going to put an extra $1,000 a month into his pockets once he consolidates that debt. But he was recently denied because he's changing jobs. So the bank denied him access to the value in his own property, right? And that's a whole other part of the conversation. So let's say, Jeff, somebody that owns a home takes what we're saying right now is like, yeah, you know what? I do want to tap into the value of my home so I can continue to build wealth and accelerate the wealth building process with that. Maybe I'm going to go buy some rental properties with it, whatever. But then you go to the bank and the bank says no. What do you do then? Right? So your money is actually locked up in this home, and the bank can tell you no. Now, realistically speaking, at some point you are going to hopefully speak to a bank that would give you access to it. But my point is, when from a wealth building process, I don't see the value of the home. Like it's not part of my wealth building philosophy, I guess. I'll end it there and throw it back to you, Jeff.
Yeah, great points. I mean, we're in a similar situation. We've been renting the last few years. We acquired my grandfather's home, shortly before he passed away. I was the only grandchild. And, so I've done both. And certainly there is pros and cons to both. I love the posts, that are pro renting that dish on, why you shouldn't ever buy a home. Like Grant Cardone is always telling you never buy a home because it's a terrible investment and your money can be, grown so much better other places. And then you flip that and people that are like, oh, throwing money at rent is just throwing it down the toilet. What a waste. You build no equity. And it's like, you have to understand pros and cons of both sides and do what works for you, like you said, in the stage of life. And then just which pros and cons do you want? Like the stage we're in, we're working towards buying another home because we want to have our own place. It goes back to control and freedom
Right.
and just having a place that you can call your own, to put your roots down. I mean, to me, there's greater principles beyond money that come into the structure of a home. I mean, there's family things, there's family ties and the roots and the things that are a part of a home that you can't get when you're renting. It
Sure.
doesn't work that way. So there's definitely those benefits. And it made me think about, one of the main things you're talking about with your brother is so many people we talk to around infinite banking and whole life and different aspects of finances that we strategize with is the control piece. And if
Hmm.
you have your money in the equity of your home, but you can't access it, you don't have control over that money. Yes, it's your
Right.
home technically. Yes, it could be your equity technically, but you don't have control over when you pull that equity out. You're at the mercy of a bank. And I know, like when we were owning my grandfather's home, we had been many years prior to that. My wife and I were in a accident where we were hit on foot by a car down in Florida. We were visiting down there, and we were not doing well financially for a number of years. Our credit was in the toilet for many, many years after we were married. And when we acquired my grandfather's house, it was kind of as we were just coming out of that, trying to do the last couple pieces to fix stuff. And I can remember specifically, like this home that we acquired was, basically a dump. It was a rundown old farmhouse, but it was paid off. So I had this home that I don't even know what the value of it was, 150, 125,000. I don't know what it was. It was a small little house. I could not access a dime of that money because they said, you've got debt and you've got a low credit score. And I'm like, yes, exactly. So if you can help me get even a portion of the equity in this home, I can consolidate all my debt,
Right.
improve my credit score. And they're like, well, we'd love to help you with that, but you can't because you have too much debt and a low credit score. And I felt like I was 18 years old again with no credit, where it was the catch 22. It didn't matter which way it went, you couldn't get
Right.
started.
Even though you own the home free and clear,
Yeah.
right?
Yeah,
That's crazy.
there hadn't been a mortgage on the home since like the 1960s or something like that. I mean, it
Uh,
was, long paid off. So it's very interesting when you're in that predicament because it's like you have the asset, you have
right.
the equity, but if you don't have control over it. So a lot of the strategies we talk about are how do you regain control over the money that you have? And it's a long-term strategy. So like you implement something in a month, you've got control over tens or hundreds of thousands of dollars. It's more of a lifelong strategy of what we're teaching around the infinite banking concept, where we have access to capital inside of a whole life policy that we can not have to go to the bank to get a loan. We're in command and control of that loan, and we can, play it on our terms if we wanted to go that route. So that's
Right.
definitely something that, speaks to me off my personal experience of like, yeah, that really sucks because on paper, I had the asset, I had the
Hmm.
equity, but it served literally no value. And it took me writing a letter, a 6-page letter to the president of a local bank that I had a relationship with the mortgage lender to convince them to give me less than 10% of the available equity in that home. It was like a several month process. So it can be, and I don't remember who said this, but it's like the proctological exam of finance is trying to get a loan. Like
Yeah.
they want your DNA, they want a blood sample, they want to know everything about everything. And if you
Yeah. It's
don't
crazy.
meet all the metrics, you're denied. You get the big rubber stamp red denied on your paper, and it can be very frustrating.
That would be, well, that would be extremely frustrating, particularly if it's paid off. It's like this asset is completely paid off, don't have a mortgage payment on it, just and now we have to beg to get access to a certain portion of it. Man, again, this is not to say not to buy a home, but also the other thing you have to think about is generally, I mean, it takes a while to build up enough equity to even be able to get qualified for a home equity line of credit, or anything like that. I suppose another argument could be made later on down the road. Could you sell the home and make a decent amount of money? Sure. But how many times do we really want to do that? I mean, I suppose if you want to live all over the place, you can do that. But generally speaking, when people buy the home, that's where they want to live, I would think, anyways. So again, from a wealth building strategy, is it that great? No. Is owning a home really good? I would argue absolutely, just not for building wealth, right? And that's why, Jeff, we talk about this all the time. I mean, the point of control is really important. It's why we love dividend paying whole life insurance. And I was actually having this conversation with my brother, because we're going to be setting up a policy for him pretty soon once he consolidates the debt. He has safe money that we're going to move into a policy. I've already explained everything to him. But I told him, like, when he got denied for the HELOC, I told him, this is exactly why I love dividend paying whole life insurance. Because there's only two questions that I get asked when I want my money. It's how much do you want? Where do we send it? That is it. There is no application. I don't need to beg for access to my money. So that's why the whole life insurance, I think, is just such a powerful financial foundation that look, again, everybody's situation is different. And I guess one of the other things that I push back on with Dave is like this one size fits all solution. Like, you know, in the video that you sent me, he says, never do anything other than a 15-year mortgage. We're probably going to talk about that later. But it's like when you use words like that, never do this, never do that. That's not taking into consideration everybody's individual situation, what their goals are, what they're trying to accomplish, right? So when I say this, I'm saying this without knowing everybody's situation, but the benefits that I just mentioned about whole life insurance, I think should like that's why I think whole life insurance should be done first and then maybe buy the house later on. Because now you have a really strong financial foundation. You have access to the capital, the majority of it in the first year. You have an asset that's going to grow. Jeff, I often compare buying a home to whole life insurance, right? Because it's going to grow over time, but there's a lot more benefits from a wealth building perspective that you get from dividend paying whole life. In addition to that really strong financial foundation, you can access capital when you need it for whatever you want. Then, as the home, you buy the home, maybe you use the policy to put the down payment for the home, right? Start to become your own bank. You start financing your large capital purchases in life, right? But then as that home appreciates, you start to build some equity. Maybe now we could tap into that equity to invest in real estate or a business or whatever it is that you want to do. That can be a really powerful thing. But just buying the home and then hoping that you're going to have all this equity and it's like going to be paid off, you're going to have all this equity when you're 60, 70 years old. Well, that's a lot of money that could have been put elsewhere. You mentioned this earlier, opportunity cost. That could have built a lot more wealth as opposed to that money being locked up in the house and you can't access it, right? Maybe take those dollars, build the financial foundation first, start to build wealth, however we want to do that. All right. But relying on the home to build wealth, I don't see it. To me, that's a very safe play where you're relying on a specific financial asset to build wealth for you as opposed to you building wealth for you. And that doesn't mean that these different vehicles and assets don't play a part, but I'm saying I'm like the idea of I'm just going to buy my house and then I'm going to become outrageously wealthy. I mean, your net worth will look good on paper, but what's that doing for your lifestyle? Yeah.
Yeah, and I
My two
think,
cents.
my growing up, has been middle class, of course. My parents, very much middle class, and even with them, when they were able to finish paying off their home, a number of years ago, it was like this huge celebration, like, oh, we finally got this paid off, and it was like that's great on definitely the one part of you don't have the monthly payment anymore. You've got that debt off your back. You don't have that, mental, you know, strain there of like I got to keep paying on this debt. There's definitely that part of it there for some people where they just don't like having the debt, and that's a valid point. But it's so ingrained in the middle class to reach this milestone of finance that when you get your home paid off, that's like kind of one of the ultimate destinations to reach. You got your
Right.
home paid off and you got the $1 million portfolio for retirement. Like you just made it, and I think a lot of that is somewhat outdated, especially in today's world, maybe more so the $1 million portfolio. I mean, it's always good to have your home paid off, but looking at that whole dynamic deeper than should I just always, like you said, Dave makes absolute statements,
Right.
never do this and always do this. Does it make the most sense for you to pay off your home? I mean, let's dive into some of this a little bit because this is what you're talking about, Matt, the opportunity
Sure.
cost. When you think about, okay, over a 15, if you follow Dave's advice, you got a 15-year mortgage and you spend 15 years taking a lot of your extra money and allocating it towards the mortgage. Now, what is your mortgage rate? Because this is something that, there's a cost of money that we have, and it's how much are we paying to access the money? So if your mortgage is, if you got a mortgage in the last 5 years, you're probably locked in at 2, 3, 4%, something. It's very cheap money in a sense. So you have to look at that. Can I earn much more money elsewhere? And am I okay with that? Do I want to do that? Or I'd rather get the 4%, mortgage paid off. Do I feel better about that? Is my wife or my husband going to feel more secure in our finances if we do that? Well, then that might
Right.
be the right decision for you. But if you've never looked at the other opportunities of, okay, can I make more than my mortgage, especially if you got a 2 or 3% mortgage? If you can't go somewhere and find a way to double your money percentage wise
Yeah.
and earn 4, 5, 6%, I mean, Dave himself says you should be able to earn 10 to 12% predictably every single year with good mutual funds that he approves. So right there by his own advice, he's telling you Don't get 10 or 12%. Make sure you pay off the 2 or 3 or 4% mortgage first before you start doing that. Now, is that safe and the best plan for some people that aren't very good with money and they don't have good habits? It's probably
Sure.
good advice. Probably should, do that. But there are people out there, and hopefully those are the people who are listening to us, Matt. There are people out there that are good with money. They're very responsible. They pay off their credit cards every month, but they still utilize them maybe for the travel miles or the bonus points that they get. And they're using financial tools to help, you know, propel themselves forward financially. Those are the people that they might want to go, wait a minute. Yes, I have this 2 or 3% mortgage, but if I can go earn 6, 7, 8, maybe I can even do what Dave says, 10 or 12% every single year in the market. Well, what does that opportunity cost? How much does that compound over 15-year mortgage? If I were to
Right.
allocate all my extra resources and not put it on the mortgage, but put it into this mutual fund that Dave says I can get 10 to 12% in. Well,
Yep.
I haven't run the numbers recently, but I think that's a
I have.
several $100 or $100,000 difference, maybe even millions, depending
No,
on the size
it's
of your.
Jeff, it's millions.
Yeah, okay.
Yeah. I mean,
So
depending on
my,
how much you're contributing, but yeah, I ran the
yeah,
numbers on that scenario. It's a lot of money.
yeah, it's been probably 6 months since I've really dove into the numbers too hard on that whole idea, but I know it's a lot of money that if you follow his advice and don't look at the converse of that advice, and like maybe that advice isn't the best for me, maybe I should be putting my money elsewhere and growing it and allowing the mortgage payment to just be the mortgage payment every month. There's no harm in that necessarily. There could be, depending on your situation, like I mentioned. But if you're good with money and you make a good amount of money, you have your emergency fund checked off, you've got an opportunity fund checked off, you've got a buffer zone there, allow the money that's in the mortgage to do what it's going to do because there's some positive aspects to the money being locked in your mortgage. The longer you have a mortgage, as inflation erodes the purchasing power of those dollars become, would you want to say, less expensive over time? Because if it's $1,000 mortgage today, $1,000 the way it spends today, you'll need $2,000 in 10 years or 15 years to spend the same way.
Right.
Well, if I'm still paying $1,000 in 10 or 15 years, when that is actually valued at $2,000 in those today's dollars,
Yep.
the bank is taking that hit. I'm shorting the
Right.
American dollar on the bank. So
Yep.
I'm now saving myself $1,000 a month because I'm drawing out my mortgage and allowing the bank to take the hit on the inflationary aspect of it. Whereas that frees me up more cash flow. Well, what if you took that inflationary difference and added that into your 10 or 12% mutual fund every year?
Yep.
Do those compounding numbers. So whether one's good or bad is not the point. It's have you considered all aspects? Have you looked at all possible scenarios and figured out and done the math for yourself? What feels good to you? Which aligns with what you're trying to do financially? And if you've only seen one side of the puzzle, you don't know what else you could possibly do. So that's
Yep.
what we want to bring to light in this conversation is, hey, have you considered everything? These are some possible things that don't get talked a whole lot about. These are the pros and the cons of, should you do mortgage? Should you put extra down on it? Should you be investing first? No one size fits all from us, but we want to give you the information so you're armed appropriately to make a good decision.
Yeah. 100%. All great points. And yeah, it's one of the frustrating things with Dave Ramsey sometimes, like on the investing side of it, is he contradicts himself. Like it literally makes no sense whatsoever when you actually run the numbers. Don't take what he says at face value. When you actually run the numbers based off of what he is recommending, it does not make any sense. I did an entire video about this on my channel. I show you the numbers. And basically what I did was I took the extra payments. He tells you to do the 15-year mortgage, make extra payments so that you can pay it off even faster or whatnot. But on the other side of the coin, he says that you can earn 12% in mutual funds on average. What that's saying is that you're assuming that you're going to earn about 12% every single year, that's not going to happen. That's why average rates of return are so misleading. There is a sequence of returns that you need to be very much aware of, particularly in retirement, right? But the question would be, Dave, is if I can earn 12% in mutual funds, why on earth would I dump extra money into paying off the mortgage? If I have a mortgage interest rate at 3, 4, or 5%, that literally does not make sense. That is called massive, massive lost opportunity cost. I mean, you're talking about hundreds of thousands, maybe millions of dollars, depending on what your financial situation is and what you're able to contribute to those mutual funds. So it's just those are the types of basic things that I think need to be asked because I believe that the majority of people, like you said, Jeff, that in some cases that makes sense. The safe way to play it, to play the wealth building game, that makes sense for some people. But I'm willing to bet that it doesn't for a lot. It does not make sense for a lot of people. And if they heard the other side of the story, then it would be something that they would at least consider because we're not talking about major shifts like we're in our financial plan here. We're not talking about becoming a financial expert or anything like that. It's just learning a couple of other more efficient ways of doing things, running the numbers for yourself. I mean, because we're talking about our financial future here. I mean, that's pretty important. And if we want to live the best life that we can, money is a part of that, right? And I don't know. In my opinion, I just think we need to be doing everything we possibly can in the most efficient way possible to keep as much wealth of our to keep as much of our wealth as we possibly can, to grow our wealth as fast as we can, you know, based on our investor DNA, as Garrett Gunderson calls it. And listen, it just doing things at face value, like make the extra payments into your mortgage, but go earn 12% in mutual funds over here. That why not put that extra money into the mutual funds? That doesn't make sense, right? And then, you know, another option is the velocity banking concept as well. You know, I'm starting to talk about that a little bit more on the channel. Again, it's not right for everybody, but it is a very, very, very efficient way of paying off a mortgage in record time. And it doesn't lock up, it doesn't change your lifestyle at all. You know, here's the other issue with some of the things that Dave says. Jeff, we were talking about this before we went live, is that some of the things that he talks about are not realistic for a lot of people, right? I suppose, like, you know, sometimes I've heard him say, like, make one extra payment every year. I think a lot of people could probably do that. And that can make a difference as far as like the length of the mortgage, right? But the problem is now that let's say it's $500. Well, that's an extra $500, maybe it's $1,000, whatever, that's locked up in the mortgage that you no longer have access to, that's no longer earning interest for you. That's something to consider. Okay. Now, again, if you're trying to play it safe, that's the way to go. But if you are serious about building wealth, then there's much better ways to do that. And you have I don't know, I don't want to say an obligation to learn it, but I just, I'm very passionate about learning as much of this stuff as I can because there's certain things I want to do, certain people that I take care of, etc. And I want to give myself and them the best life possible. So that requires me to learn strategies like infinite banking, velocity banking, like, and just maybe those strategies aren't even right for you, but just asking the question, is there a better way to do this? Is there a better way to pay off my mortgage? Is there a better way to build wealth? Should I do mutual funds? Should I do index funds? Right? Just start asking questions and analyzing, analyzing different strategies, but making sure that you're hearing different sides of the story. Because if you just take what he says at face value, you know, 30 years could go by and you could realize that, holy smokes, that was not the right decision. And it's cost you a lot of money, unfortunately. So back at you, Jeff.
Yeah, I know it makes me think of a client. It's a family member of ours that, you know, we've helped her with like an annuity and stuff. And, you know, up until we got into doing financial strategies a few years ago, you know, she had her advisors, which she still has. And now that she's retired, it's been interesting as we've recently been reworking a older annuity that was, you know, the right fit at the right time of stage of life for her, but we needed to switch it into something that was going to produce income now. And looking at like the overall portfolio, and this is something that, you know, since we've come over at Life 180, I've really enhanced my understanding and knowledge of the overall portfolio. It's not just everything revolves around infinite banking, but it's seeing someone's overall portfolio and where are the gaps in the plan? Where are the inefficiencies in the plan? Because
Yep.
by and large, every advisor, for the most part, I mean, there's some good ones out there for sure that, you know, are going to do exactly what I'm saying, but a lot of them are just taking cookie cutter advice. It's what their boss told them to sell and they're going to repeat that. And so most people are over leveraged in the market and they have most of their foundation is in the market. Their investing is in the market. Everything's revolving around the market.
Yep.
And that the market, the rate of return, your net worth is supposed to solve all of your financial problems. It's supposed to be this one strategy that's going to meet your income needs in retirement. It's going to be your legacy play for your kids or grandkids or whatever. It's going to be your long-term care play. Because if you need long-term care, you've got such a big pile of money, you're just going to use that for that. And it's like, but you're
Yeah,
not
right,
asking the question, is that the most efficient way to go about all those things? And
right.
then we were talking before we went live about the One America Symposium. This is one of the things that we learned at the One America Symposium, I think in 2023, was talking about how when someone is in the retirement stage and they start, if they are getting enough income from investments, or maybe they're still working part-time, there's different tax levels that you can hit where you're going to actually have to pay back some of your Social Security. And this happened to my parents a couple years ago. My dad made enough money one year where they actually had to pay back almost 50% of the Social Security that they got. So it's like a success tax. And if there's
Yeah,
proper strategy prior to those things coming into play, there's ways to offset those taxations being in vehicles that are off the radar screen of the IRS, hence cash value life insurance.
right.
And even with this other relative that I'm mentioning, it was interesting to get into the discussions with her now because now it's starting to come to light as we've had a few calls with her looking at the overall plan. And she's like, well, how do I avoid this problem? How do I avoid this problem? And it's like, those should have been implemented 10 or 15 years ago,
Yep,
and they probably would have come around being having a good portion of your safe money, your fixed money that would normally go in the bond portion of your portfolio, which is usually 30, 40, 50%, depending on your risk tolerance and your personal, desires on that. Um, but that being in a cash value life insurance, that can solve a lot of those problems because you've got the death benefit there. The death benefit is the most efficient way to pass money along to the next generation because it's
yep,
the multiplication factor. Whatever you've put into the policy is going to be less than what the death benefit pays out to your beneficiaries, unless you are like 120 years old, where it's basically even 1 to 1. If
right.
you die anywhere short of that, they're going to get more in a death benefit than you've had in cash value and what you've paid into it. That's a multiplication factor. Everything else that you can transfer, like a home, there's going to be taxes that come into play. There's going to be transfers of stuff that deduct some amount of money from the situation that you're in. And, it still can work. You can still use the home as a legacy play. Certainly it's wonderful. Like we use that. I mean, it was a legacy play for me. My grandpa, I was the only grandchild, like I mentioned, we got the house. It was perfect timing. It was the stage of life right after we had our son. He was a year and a half, 2 years old. It worked out great. We had a home. It was free and clear, helped us get on our feet after the accident several years prior. So those things can be wonderful tools, wonderful things to have happen. But if we're not asking, like you mentioned, Matt, the deeper questions of like, is this the best way to go about this? Is there a more efficient way? Is there a better way to do this? Is there a way that it might be what Dave Ramsey says don't do, but maybe it actually makes more sense for my situation? Maybe there's math and actuarial science that validates that I should do this, even though
Yep,
Dave says in a book, don't do this. So just asking those questions can mean, a big difference. And so seeing the efficiencies of how you handle all these different things. And I mentioned earlier, having money in the traditional qualified accounts, 401ks, IRAs, all those things. Those are great at building cash. They're growing cash. Those are great vehicles to grow your money, but they're not efficient for taking distributions for the income side.
right.
There's more efficient vehicles like annuities. A lot of times they're much more efficient. Sometimes can be, if you're following the safe withdrawal rate of 4%, a lot of times annuities can be, 50% more, maybe even 100% more than that, based
Hmm.
on the amount of capital that it takes to get that type of income. So those are aspects that you need to look at instead of just listening to Susie Orman that says annuities are horrible, whole life is horrible.
Hmm.
Maybe actually look at the numbers and understand it's not an all or nothing. It's having pieces of your portfolio doing more efficient things and doing what those tools do best,
Yep,
keeping some money locked in the market because those are best at growing your money. And if you have had enough money to prepare for retirement, you can utilize more growth, right? While you have another portion allocated with some, maybe with an annuities, maybe some with different products that allow you to have safe and secure, predictable income coming in to meet your needs and above and beyond. There's is it Matt Love, I think, that calls it a play check, or maybe it's Tom Hegnan that I think calls it a play check. Having an annuity is your play check. If you
yep,
know there's a check coming in every single month that covers my bills, covers all my needs. I've got another play check, maybe from a second annuity that allows me to go golfing every, 3 days a week, allows me to go on trips, allows me to go on a cruise once a year, allows me to go visit the grandkids across the country, whatever it is, you just know for certain that those things are taken care of.
yep.
Like, that might be a better, situation for you to be in, a better portfolio for you to have, instead of relying on the rate of return to be able to accomplish all those things, because they may not do that. What if the market dips at the time you need long-term care and you're relying on your big stock portfolio to pay for your long-term care? Well, that may not happen. It may be the wrong thing at the wrong time, and it could really cut into your ability to have long-term care provided by, your investment portfolio. And there might be better, efficient ways, like a long-term care policy that's going to be pennies on the dollar for the coverage you're getting. So, it goes back to the adage of, do I want to spend more than a dollar to get a dollar of coverage? Do I want to spend a dollar to get a dollar of coverage, or do I want to spend pennies on the dollar to get a dollar of coverage? And that's where insurances come into the overall portfolio to make sure it's efficient and you have different situations covered if they come up, so that hey, I'm doing the most I can with the money that I've got, or the money that I've saved up over my entire lifetime, and I can make sure that I'm utilizing it as efficiently as possible. I can give as much as I possibly can to the next generation to get them a startup, in their lifetime. Like, all those things come into play, and those are things that, again, not directly opposed to everything Dave teaches by any means, but just asking those deeper questions and analyzing other numbers. And I know you and I talk quite a bit about it on the IUL side, of really understanding, what is the opposition, why are they so opposed to annuities? Why are they so opposed to whole life? And understanding those viewpoints. And really, once you understand other people's viewpoints, then you can figure out, okay, well, what do I believe now? Because if you're just taking somebody else's, knowledge, or, something that Dave says on his podcast or something, then how do you know it's right for you? If you can analyze it deeper and understand the reasoning behind it, then you're much more apt to make the best decision for you. And that's what we want to empower you with doing content like this, is so you're empowered to see different sides of the perspectives that you're probably not hearing a lot of times, and seeing how it fits together. And I think more times than not, Matt, we talk to people that it's like, I've been looking for somebody that can explain big picture, that can put all the pieces together. It's a more holistic understanding of my finances, instead of a very, pigeonholed model that's relying on the stock market to do all these things for me, when I know probably innately it's not going to happen, but I just don't know what else to do. And that's where we love sharing this kind of content. So those are my thoughts on that. I'll throw it back to you. I'm sure you got some other content around that.
Yeah, man. No, it's all good stuff. That's how you're talking about just asking questions and researching different tools and stuff. And that's how I got to where I'm at right now. Is I literally just started asking questions like, what's the best way to put my money to work, right? So I fixed the income problem in my life that I had. My business started taking off. I was starting to save money, right? The question is, okay, what do I do with this money now? And I knew inherently I didn't want to go the traditional routes with 401k or IRAs and all this other stuff. Not saying that they're bad, but I just knew that there's got to be a better way, right? Than just parking my money into the stock market and hoping that's going to build $1 million, $2 million portfolio, right? There's just got to be a better way of doing it. And actually not even necessarily a better way, a more holistic way of doing it, right? And different tools that I can use and stuff. And man, when I started going down this rabbit hole, it's just like, man, I can't believe some of this other stuff is just not taught. Like, once I finally understood the infinite banking concept, that was like an absolute no-brainer to me. Particularly from an efficiency standpoint. See, for me, it's all about efficiency. Are we putting our money in places where it's going to be the most efficient, where it's going to give us the maximum amount of benefit? And bringing it back to the home ownership example, is dumping a bunch of money into a home to build wealth the most efficient way to build wealth? Not really. When you actually look at numbers, and assuming you're not just trying to play it safe, you want to actively build the wealth in your life. But as soon as you start understanding how these different tools actually work, right? How dividend paying whole life insurance works. It's actually not as bad as Dave Ramsey says it is, or Susie Orman. When I started learning about annuities, not nearly as bad as what Susie Orman says. And I'm not sure of Dave Ramsey's stance on annuities. I don't see him promote them very frequently. So, and he's also a big proponent of a big advocate of being a self-insured, which is just a joke in my opinion. That's a whole other video. But like, once I started learning about annuities though, for example, it's like, this is an incredibly efficient income vehicle. Now, when you listen to people like Susie Orman, maybe Dave Ramsey, talk about annuities, they're usually talking about one specific type of annuity when they talk about like all the fees and stuff. That's variable annuities, which I don't know why anybody would ever do a variable annuity. Maybe it makes sense in some cases, but if you could generate the same amount of income with far fewer dollars in retirement, why on earth would you not do that? What that means is that you could actually take a portion of your portfolio, generate the same amount of income, and still have a lot of money left in the portfolio that you could just let ride, continue to ride for another 5 to 10 years. And then when you need a pay raise, you can take more out, buy another annuity. Now you just got a pay raise, but that's guaranteed income for the rest of your life. Do you get a guaranteed income from a 401k portfolio? No. You talked about sequence of returns risk as well. The 4% rule. If you listen to Dave Ramsey, he says you can take 8% because your mutual funds are doing 12 every single year. Absolutely insane. But at the end of the day, guys, it just comes down to asking questions, doing your own research on this, trying to figure out how these different tools work and how they fit into your own wealth building process and strategy and financial plan. Like, just don't take these things at face value. For me personally, home ownership, not a good way to build wealth. Not to say not to buy a home, just don't buy it for wealth. Like, it can serve you later on down the road. Particularly like like I said, I'm a big fan of velocity banking, using the HELOC to pay that mortgage down very, very significantly without impacting lifestyle whatsoever. I think that's a great tool, a great strategy that just about anybody could implement, right? You don't talk about that though. It's just you have to ask yourself, is what I'm doing, is what I'm putting my money into, is it moving the needle in the right direction the way I want it to? And as much as I want it to, or is there a better, more efficient way to do it? So those are my thoughts.
Yeah, those are some great wrapped up thoughts. I think, we really hit it home as far as, doing research, really looking at all sides of a scenario, really thinking outside the box. I mean, that's a principle that served me my whole life of, looking at what does the mainstream say? What do the masses say? And like, okay, is there a better way to go about this? I mean, I had acne growing up. Okay, well, I asked some different questions. Is there a different way than Accutane to deal with acne? Oh gosh, whole body cleanses. Wow, it fixed it in 2 weeks, and I've been struggling with it for 6 years. Man, glad I asked a different question.
Mm-hmm.
So that is really, I think, the crux of what we want to encourage you to do is, take what we say, don't take it as absolute gospel truth, challenge it,
Yep.
analyze it, understand it, go to the opposite side. There might be 3 or 4 viewpoints on some of this stuff. There's no right or wrong. It's what's best for you. We're coming at it from a perspective of more of an entrepreneur mindset. We want to grow wealth. We want to expand. We want to have a bigger impact. And I know not everybody's like that. I have family members that's the farthest thing from their mind. They don't care. They just want to live the simple, basic life. And if that's for you, then probably our advice isn't in alignment. But more than likely, the people that are going to be watching this are going to be the entrepreneurs, they're going to be the chiropractors, they're going to be the marketers, they're going to be all those kind of people that are wanting to know, what can I do with my money? Because we live in a world right now where, money doesn't go as far as it used to. I was in Whole Foods the other day. It's like, I only bought a few things. It was like $119. And I'm like, are you kidding me? I remember a few years ago, I could come and buy like the whole week's groceries for $119. Like,
Yeah, but Jeff, at least you have a home that's paid off worth $500,000. You can't afford to buy groceries, but at least you have all that equity in your
true.
home.
I do feel wealthy. I do feel wealthy.
At least
knowing
as
I
long
got
as you
that.
feel wealthy, that's all that
Right.
matters. As long as you have wealth on paper, that's all
Right.
that matters.
Well, that's
Not
why
about
I
what you could
carry.
spend and how many groceries you could buy, about how it looks on paper.
I just keep a piece of that paper in my wallet and I look at it. It makes me feel better at the grocery store, knowing I could pay with this phantom money, but I guess
Sounds
I
like
won't.
a solid financial plan to me, man.
Exactly. So, with all that, thanks for tuning in, guys. Check out Matt's channel, Millennial Wealth Creator. He's got tons of great content on there. You and I have done a lot of content together, and you just create so much amazing content going into a lot of the things that you're doing on your journey that are different than what I'm talking about on my channel. So make sure you're subscribed to his channel. Amazing content over there talking about his private money lending, his journey with infinite banking, how he sees money, how he utilizes money. I think you're talking about, some good guests potentially coming on your podcast real soon. So I'm excited to see
Yep.
those. Just great content over there. So make sure you subscribe to his channel as well. And if you're
Thanks,
not
sir.
subscribed to my channel here, please make sure you are as well. Hit the alert button so you're notified anytime I or we create content, because we'll be doing more of that throughout the year, of course. And look forward to the next video. Thanks for joining me, Matt. Always great to be with you, my friend, and
Thanks for having me.
sharing what we love.
Yes,
All
sir.
right.
Looking
Take
forward
care,
to it.
everybody.
All right.
Talk to
Bye.
you.